You're listening to Toronto's #1 real estate podcast, powered by Watson Estates. The most successful local real estate investing starts right here, right now. Here's your host, broker, investor, and social media influencer, Bradley Watson.
Good morning, investors. Bradley here from Watson Estates, and I'm so happy you could join us this morning to kind of go through some of the stuff that we saw this week in Toronto real estate. We are #1 on Google Podcasts for Toronto real estate, and thank you to our viewers for making that possible. I'm just floored by the support and the comments and the ability to stay connected with my clients and making new friends along the way. So thank you for tuning in. If you guys are getting value, make sure you leave us a review and leave us a comment and help us continue this dialogue as we look at the daily news coming out in the Toronto real estate market. Now, today's going to be a bit of an interesting podcast because I'm going to hit you guys with a couple very, very negative news articles. Both of them are talking about the same reports that comes out of a credit ratings agency called DBRS Morningstar. But because they appear as some of the top articles coming out of the news this morning in Toronto, they came out just yesterday and they are still sitting right at the top spot. We need to talk about this. So what's going to be interesting about today is you're going to get a very interesting picture. This is going to be the type of podcast that both the Bears and the Bulls love. Regardless of your position on what the Toronto real estate market looks like, you're going to find some information in here that's going to reaffirm your belief. So I'm excited to jump into today talking about what are some of the worst estimates for Toronto real estate. Then we're going to get into how bad are the April job numbers that came out in Canada for the month of April. And is the government spending enough to support the economy? And we're going to get into that because there's been some big announcements as of late as well. So this is kind of fun. I love getting up in the morning and doing this because I was just thinking this morning as I kind of put on my house coat and get out of bed, roll out of bed while everyone's still kind of in bed. And it reminds me of when I was a little kid and some of my fondest memories was being over at my grandparents, and my papa would always be sitting up at his table, reading his newspaper, having his morning coffee. And I just think it's so funny to see that it's kind of circular. Now, instead of sitting and reading a newspaper, I'm sitting and reading a desktop computer. I guess it's not even a desktop, a laptop computer, and sitting here and talking to you guys and getting some of the latest news. I just like it. I love it. I love being able to think that it's kind of circular. And having lost my grandparents has been very difficult. And so looking back and knowing those memories are still there and in a way being relived has been very cool. So thank you guys for that as well. So let's get into this article talking about DBRS Morningstar. Now, I looked up on their website just to get a little bit more if you've never heard about them. They are the world's 4th largest credit ratings agency and a market leader in Canada. They actually have approximately 700 employees in 8 offices globally. So they are a global company reviewing Canada. Now, for a lot of people, they would say, well, that shows some legitimacy, right? Because they go outside of Toronto. They're not kind of tied to one marketplace. Okay, fine. We'll give you that. So here's what the article says. The first one comes from Toronto Stories, and it's called Home Prices in Toronto Could Drop More Than 14% by 2023 Report. This is the article. The economic fallout caused by the coronavirus pandemic has halted major industries across the board and left Canada's real estate market at a near standstill. That much is fact. What this means for the future of real estate and real estate prices is still up in the air, but in the lead up to the outbreak, the housing market was definitely, quote, heating up, with resale activity and home prices increasing at the start of the year. As lockdown measures unfolded, though, the housing market lost momentum. In March alone, home sales fell 14% month over month, while over 3 million Canadians either lost their jobs or worked fewer hours. That number actually seems low to me, the 14 month over month, because we've seen far more than that. I think it's just because March was impacted mid-month, and so we kind of saw that carry forward into April's data as well. Regardless of the various income support programs from the federal government and the mortgage deferral options from the banks, the rise in unemployment could lead to the inevitability of more households falling behind and potentially defaulting on mortgage payments, which could in turn lead to home prices falling in the coming years, according to a new report from credit ratings agency DBRS Morningstar. There's their name right there. So what they did in this report is they offered 2 scenarios. Okay, this credit rating agency here. In the moderate scenario, mortgage arrears nationwide increased to approximately 65 basis points in 2020 and then gradually declined, while home prices fall by 10% cumulatively through 2022. So expecting price declines of 10% through to 2022. The adverse scenario features mortgage arrears rising to 100 basis points and a 15% correction in housing prices by 2022. And that's where they get the title for that, 14% or 15% drop in prices until 2023, or whatever the article title was. Yeah, 2023. However, home prices are also expected to decline more sharply in urban areas, and this is how we kind of wrap this into Toronto. Their expectation is that it was expected to fall 14% in the moderate scenario, but 18% in 3 years. So they're expecting further decline. So if you say we're kind of 8 to 10% drop, they're expecting another 8 to 10% drop in prices over the next 3 years in this article. According to the report, all 10 Canadian provinces would experience sharp recessions in 2020, even in the moderate scenario. So a very extreme article, right? In fact, I would say out of all the ones we've read in all the reports, we've done CIBC, RBC, CMHC, TREB, and I'm probably leaving some out, TD, right? TD actually had some pretty negative ones as well. But this is the worst. This is definitely the worst. However, the variation across the provinces largely reflect whether the province is an oil producer. For example, Alberta, Saskatchewan, Newfoundland, Labrador are projected to suffer the largest declines in GDP. So they're going to get hit by GDP, but yet they're saying it's our areas, Toronto, for example, which are going to be most impacted. And so I kind of leaned on Better Dwelling, our friends over at Better Dwelling, keeping it real over here. And they talk about, I grabbed part of the same article. They're kind of, They've looked at it from a different angle, which is why I like to look at it from multiple angles. And don't worry, it's still negative, guys. We're not going too crazy here. So what they're saying in their article is Canadian real estate is 20% overvalued. So what they've said here is Canadian real estate is overvalued. We know, not a shock for non-Canadians, no surprise. You know why? Because we're awesome. The firm estimates prices across the country are 20% over their fair value. In a modest scenario, they expect a 10% pullback across the country. In an adverse scenario, they expect the prices to fall 15% from 2019 values. Even in the adverse scenario, prices aren't expected to reach fundamental levels, likely due to moral. So what they're saying is we're overvalued by 20, but really we're going to see a 15% drop. And the reason is because of the repeated attempts to prevent corrections at much lower levels of fundamental detachment. So they're saying that we have a tendency to catch the thing before it drops all the way down. That's what I hear there. And then Toronto real estate prices are 26% overvalued. Toronto is the most overvalued region in the forecast and is expected to see a bigger correction. The firm believes Toronto is 26% overvalued and will see prices decline 14% in the modest scenario and 18% from its 2019 values in the adverse scenario. Here's a fun fact. We're down 8 to 10%, right? So in the worst case scenario, we're looking at another 8 to 10%. In the best case scenario, we're looking at closer to a 4%. Depends on where you fall and how extreme this is. Now, I hear the argument a lot whether it's overvalued as an explanation for a correction. And I think that that's a little bit manipulative. That's my thinking. My understanding is the reason we're overvalued just means you don't see the value for the prices you're seeing, right? So the prices don't reflect the true value of the marketplace. But the overvalued, where I have trouble listening to when people say, oh, it's overvalued this much or that much. The reason that it doesn't sit well with me is because it's very difficult to quantify that, right? Like if you're going to say it's overvalued, you're maybe putting a lower value because there is values that cannot be calculated necessarily financially, right? Like you can't just take math and say, oh, therefore it's overvalued 20%. Now they're doing that because we've got no better framework to do it. But I would say that increase in value is kind of like in a business, it's the goodwill, right? Like it's the X factor that happens in our marketplace. That's how I see it. Maybe I'm wrong. Leave it in the comments as well. Let me know why you guys trust this overvaluation as a reason, because I don't fully understand why being, quote, overvalued is a reason for a downturn. But I know there's a lot of people who hold that belief. So I'd be interested to hear that in the comments as well. But so that doesn't shock me too much. But let's take what they're saying as this credit agency saying a 14 to 18% drop. That's still the highest we've seen. So that's for all of our bears out there, people that are very thinking. I'm not going to say they're negative because I honestly don't think people who think the market's going to come down are negative. I think they think the prices will be negative, but I think that they are optimistic that the market will come down, if that makes sense. So let's not point fingers and say, oh, you guys are so negative. It's not necessarily the case. They are looking for opportunities just like we are. But here's what I'm seeing, okay? I tend to be a little bit more of a bull compared to these guys. It's very easy to be. But let me tell you kind of what I'm seeing. So we've seen forecasts. The forecasts so far have said anywhere from up 10% in 1 year, in this year, to down 10%. Now we're seeing it saying over the course of several years, it'll go down further, up to 14%. But in every case, there's always mention that it's a high degree of uncertainty. Like they're not hiding from the fact that they don't really know. We're just throwing numbers out here and hoping they stick. And I tend to think people will lean towards the negative meaning on the side of it being worst case scenario, knowing that if it comes better, then they've now kind of outperformed. And that's good news, right? So you want, when it's bad news, get out your bad news. When it's good news, you want really good news. And I think that that's kind of the way it swings. But even still, I'm starting to see that they've all mentioned very high degree of uncertainty. There's a lot of uncertainty, guys, because we don't know what comes next month. But what I am seeing is I've seen a month of inventory virtually go flat, right? Like, and it actually has landed in seller market territory. So we were seeing prices coming down, but also we were seeing the number of sales dropping dramatically, but the number of active listings were going up. But now we've seen that number kind of balance out to a point where months of inventory have not changed. So typically months of inventory are indicative of whether prices are going to go up or down, and in a seller's market territory or under 4 months of inventory, which is where we are, actually tends to lean towards a price increase. That's how that works. So we're in that zone, and unless something were to shock the system, that's kind of where we've landed. And the province is set to reopen. Let's not forget all of the news coming out on that. Whether that goes 100% of the way or not is to be determined. Again, the uncertainty. But as of right now, things are reopening. Prices have already dropped by double digits. If in fact 15 or 14% of they said in this article, which is their kind of neutral zone and still more extreme than the others, if that in fact is the bottom, then we're not that far off, right? Like if we are expecting a 15% drop from 2019 prices in Toronto, and we've already experienced an 8 to 10% drop, then maybe we're nearing the bottom. And first of all, I don't think 15 is where we're going to land. I don't think that is the bottom, but maybe. And even if it was, you're still within 5 or so % of the bottom. Because what I'm seeing now is the number of showings going up, and I've seen a bit of an uptick, and things seem to be kind of, the months of inventory, for example, seems to be kind of getting to a close bottom where it seems to be swinging. Now, I did a podcast not that long ago. Go back and check it out. I think I have it here in my notes. Yes, podcast number 38, Rock Bottom Real Estate Prices. Go back and check that one out if you want to hear kind of my logic for why I think prices, the base of prices may be behind us. But we're going to keep talking about it anyways. But if you want to go back and get more solid on that, go back and check it out. So here's what I'm seeing on the ground, right? I wanted to, again, I am a small fish in a really, really big fat pond called the Toronto Real Estate Board. And I know what my clients are doing. I know what the market is doing because we're doing this together every single morning. We're learning and we're picking up the news and we're kind of creating our own thought process. And so here's what I'm seeing on the ground, guys. Many of my buyers are starting to come back. So I'm not saying all of them because there's still a good chunk of the who are not. But people who have been on the sidelines, I'm noticing are willing to start to come back now. And I'm even seeing sellers wanting to come back. Why is that important? Because a seller coming back from my clients, I was fortunate where my clients were, none of my clients were in a financial position where they had to sell. And so I was advising them, if at all possible, to wait on selling because I don't think the selling prices are going, the fear and this overall uncertainty out there is what has stimulated a lot of price drops in my mind. And so if we can ride this out for the next 6 months or so, there's going to be a lot more optimism. Maybe prices won't come flying back, but the optimism will be there where you're not going to get screwed with lowball offers. And so now, because we're starting to see an uptick in buyer activity and an uptick in showings, which is the other side, I'm seeing a large uptick in the number of showings. Maybe that's a confidence of people seeing that the market seems to be reopening. But all of these are encouraging sellers now to consider when they're going to put their property on the market to get, like if they wanted to sell it and they still want to sell it, things are starting to look a little bit more optimistic. And just so you know, I've been calling other agents because as I've been kind of mentioning in my podcast, for people who think the markets are going to go down, my logic is, well, then why not lowball them? If you think that's going to be the case, there might be a seller out there who does too, who's a little bit more desperate to sell. Why not throw out your lowball? So I have clients doing that. I've been throwing out lowballs and I've been getting feelers out there. And what I'm finding is that a lot of them, so I had phone calls with agents out in Milton, out in Oakville, and in Mississauga yesterday, and all of them are mentioning interest is going up, okay? So if you think interest is going down, things are getting worse, that's not what I'm hearing when I'm booking appointments right now, guys. People are getting more confident. People are, even though the numbers came out in April were low, I think there is enough education out there to see months of inventory are flat, and they don't want to get caught in the type of booming multiple offer environment we had before. So they're trying to get in early, and there's a lot of them. And they're getting more confident in going out and doing showings because the fear of COVID-19 seems to be wearing a little bit. Not to mention it's spring and it's nice weather and people are trying to get out. Okay, so if you want, I know that's been a lot of negative news. I've been trying to add a little bit of optimism in there. If you want more optimistic news in nature, please go back to episode 45 and 46, and you can kind of hear some of the more good news. Unfortunately, this is the biggest news that came out today, and that's what I want to share with you guys first. But there is definitely optimistic news, and this is why we do these podcasts, because we can't just take one day's news and just kind of create a framework from that. We need to understand the market, which is very dynamic in nature. So here's what I think, guys, just to kind of wrap that up and before we can move on to job numbers. I think the question isn't so much about how much it will fall. More so, it's the question of how much it will rebound. Because here's the thing. If we've already seen an 8 to 10% price drop in a matter of a couple months, and some people are saying, minus 10% on average, and the other side is saying, okay, it could be up to 10% on the increase in a single year, because that's what the numbers actually had said coming out of, I think that was TD, 10% in 1 year increase. I can't remember which article it was. I mixed them all up. It was one of the banks for sure. So if that's the case, then the question is are we going to how fast are we going to rebound, right? Because we've already seen the majority of in every case, even in the worst case, we've seen the majority of the price drop. So is it going to increase this year? Is it going to increase in 3 years? So I think a lot of people are still caught in, prices are so scary and don't go in because prices are dropping. Whereas for people who are understanding what the stats are showing, even in the worst case scenario, they're not necessarily saying further giant price drops. What they're suggesting is how long it will rebound based on the strength of our economy on the other side of COVID-19. Hopefully that gives you guys some clarity on that. I just wanted to make sure we're all on the same page here, because I don't want people to miss out because they're looking at it from the wrong angle. If you're looking at it from the correct angle and you still don't want to get investing in the market, there's a lot of people like that. Good for you. No problem. Okay, let's move right along. Let's get into Statistics Canada's job numbers. But before we get into that, I want to kind of talk about the job number leak that happened, because I think that's kind of funny. Statistics Canada has launched an investigation after a media outlet reported its latest job loss figures more than a half hour before the data was officially released. I think that's kind of silly, right? It actually really screwed with our marketplace. Because people were thinking, because it was actually generally optimistic news. It was good news, by the way. We'll get to that in a second. I guess it depends on your perspective. But the official data is released by Stats Canada at 8:30 typically. But according to a tweet by Bloomberg Canada, the link article's timestamp, the report was published at 8 a.m. So the article kind of talks about how some people were able to manipulate the market and outperform, and then it kind of rebounded after that. But they said, quote, "We take this very seriously, and the government will put the necessary processes in place to ensure this does not happen again." I think it's kind of funny. You get a leak happens. Okay, fix it. Plug the leak. But interesting stuff. So what were the job numbers, right? Because the job numbers, the unemployment, if you follow our podcast for even a couple of weeks, I've said unemployment. That is, to me, probably one of the biggest. Immigration would be another big long-term impact, but unemployment is the biggest one everyone's talking about, right? Based on how much unemployment we experience and for how long this lasts will determine unemployment will lead to not increasing in price or our market rebounding very quickly. So here's the numbers. Canada lost almost 2 million jobs during the month of April, a record high as the impact of COVID-19 on the economy made itself known. It brings the total of jobs lost during the crisis to more than 3 million. That's bad news, right? We got 3 million people out of work. Okay, there's your negative side. Statistics Canada says the unemployment rate soared to 13% as the full force of the pandemic hit, compared to 7.8% in March. Economists on average, here's the good news, had expected the loss of 4 million jobs and an unemployment rate of 18%, according to financial markets data firm Refinitiv. So we actually did 50% better. I guess that's how you do the math. I sure hope so. Math is not my strong suit. Ironically, I graduated in finance. You don't need to know math to graduate from finance. But we performed twice as good or 50% better. I don't know. You do the math. We were expecting 4 million and we lost 2 million. So yes, we still lost 2 million jobs. Take our hats off, right? There are these are real people who have lost their jobs. But at the same time, we expected far worse. The 5.2% point rise in the jobless rate was considerably less than expected, the massively smaller than the 10.3% point spike in the US job rate. So the US got hit 10%, and here we are doing significantly better. And so what this article kind of goes on to talk about to kind of graze it. First of all, Great Depression, by the way, was as high as 30%. So again, not nowhere near that. So depending on your thinking of where the market will go, we don't even look close to those numbers. I guess it depends on how long things are closed, but again, things are opening. So where do you fall on that is up to you. The number of people who are employed but working less, this is a good point too, working less than half their usual hours because of the pandemic increased by 2.5 million. So that's another good chunk, right? Like not everyone necessarily lost their job. Some people had far reduced hours that would screw you up as well. There's evidence to suggest, however, the pandemic-related job losses are temporary. That's another good point. So see, the cool thing about articles like this is you see both sides. And you kind of, if you were sitting on this like kind of pendulum, you'd lean one way and it's like, oh no. And then you kind of lean the other way. Oh my God, we're good. Oh no, I'm actually rocking back and forth because I'm a loser. But like the news pulls you back and forth. So it's like, is it good? Is it bad? Is it good? Is it bad? And I would say that is the decision that's up to you guys. I can't make that call. But according to economists, it is optimistic. But of course, these are real numbers affecting real people who had real jobs that are lost. But they're saying that these are temporary, right? A lot of these jobs are temporary. In the month of April, almost all the newly employed, 97% were on temporary layoff, indicating they expect to return to their previous place of work. So this isn't just total unemployment. A lot of this is temporary unemployment, which would indicate that it's actually a little bit better, right? Like in theory, they're going to come back. And so it comes back down to, is the government offering the support it needs to maintain our economy, which we'll get to in just a second. But before we go there, I think it's important to mention one of the most underappreciated people groups here in Canada are vulnerable workers most affected. Losses continue to be more rapid in jobs with less security and poorer pay. Overall employment declined 17.8%. Temporary jobs declined by 30%, right? So it's far more. And those who had been in their job 1 year or less is 29%. Again, a lot of temporary jobs there too, or temporary layoffs, but still, numbers are far higher. The employees earning less than 2/3 of the median hourly wage of $25, they were affected 38%. That's the highest from what I can see here. And those paid by the hour, 25% drop. So clearly people who are being on the lower end of being paid that are typically frontline employees, the most vulnerable, are the ones that have been hardest hit as far as job losses and whatnot. And if they don't qualify for the benefit, who's going to care for them, right? The other thing to mention is small companies have been hardest hit. We can see that in the numbers. And that would be defined as anyone with 20 employees or less. They have shed 30% of their workers. Medium-sized companies have shed 25% and large companies 12%. Again, a very big discrepancy on whether you're a large or small company, which is why when I hear big companies saying that we should remain closed, I kind of turn my cheek and I'm like, I don't know. Might be a conflict there, but that's what the numbers are saying. So where I want to go with this is ask the question, because this has big impact on our real estate market. Is the government spending enough to support our economy? Given we've turned off the taps, we've closed it, we have said nobody's allowed to work. Both conservative and liberals agree we need to compensate people for having told them to stay at home. The question is are we paying enough to support and prevent, job losses and provide enough money for people to make it by in order to protect our real estate market, right? Because the success of the nation will determine the purchasing power of that same nation. So here's big news. I put it at the end because I wanted to go through some of the job numbers and show that essential workers are being hit very hard. And so I think this is a good time to have this money being thrown out. Now, we don't the way that they write this article is CNN. They say Canada is giving their essential workers a pay raise they, quote, deserve. And I think that that's a fuzzy word. It's kind of like when I hear these daytime lawyer TV commercials. Not that I sit and watch daytime TV, but you guys know what I'm talking about. Don't pretend you don't do that. You don't see these things. When I go over to my grandmother, she watches this stuff. So they'll say, get the money you deserve, right? You get in a car accident, call, I'm not going to name any names because I don't get sued, especially don't want to mess with those lawyers. Anyways, a lot of them are US lawyers and whatever, but they say, get the money you deserve, right? Okay, fine. You're entitled to that money, possibly in that case. But it's like, when you say we deserve that money, like if you were to collect the emergency benefit, do you deserve the emergency benefit? No, not really. You're being reimbursed, but I don't know if you can say you deserve it. I just think it's kind of a rough word. Everyone feels so entitled. Why are we so entitled these days? Anyways, but these guys, if anybody, should be compensated, right? Like they are the ones actually working. Many of them are getting paid less than the emergency benefit, but more than the $1,000 that would qualify them for an emergency benefit. So this is good news in my mind. Canada is hiking wages for essential workers across the country in a blunt admission that many who are now facing risking their health to work during the pandemic are in some cases making the least, because we've seen that in the job numbers, we've seen that in the pay, whatnot. If you are risking your health to keep this country moving and you're making minimum wage, you deserve a raise, said the Prime Minister. Trudeau's government hammered out an agreement with provinces and territories to spend more than $3 billion with a B and raise wages for essential workers making less than about $1,800 a month. So you're kind of meeting those people under the 2,000, but over the 1,000. It seems to be that's what they're doing. But here's a funny story. I have a family member of mine who actually works at LCBO, and I sent them this article. I'm like, here you go. Finally, like maybe someone's going to take care of you. You know, like she doesn't want to work, but she's working to make ends meet, and she hasn't been able to qualify for anything and is making less than everyone else sitting on a benefit. So I'm like, oh, great news. Here you go. And she turned around and said, well, LCBO is a union, and so we actually don't qualify for this particular benefit. So what's trying to happen here is I think we're trying to fill in the holes. We're trying to help people, but there's going to be a ton of holes that are not being filled. And here's a quote from Trudeau. I think one of the things that we're seeing through this pandemic is that there are people who are tremendously economically vulnerable in other ways in our society who are extremely important to the functioning of our society. It is all around good news. It will care for more people. I mean, in the way of $3 billion. So when people are thinking, like when we're talking about the drops of like, okay, we're overvalued by 25%, but we're only going to, decrease by 15 or 20% because the government will support those programs. I think personally, if that is the case, the government spending right now is so high that I think that kind of safety net is far higher than what some of these news articles are saying. But that call is up to you. Here's another $3 billion that we will not see again, that our future generations will have to pay in order to keep our economy propped up during this COVID-19 crisis, which generally is protecting the finances of Canadians, right? And again, is giving people that encouragement and motivation to go out and look for real estate. I'm going to leave it there today, guys. I hope you guys have a wonderful day tomorrow. I will not be on because we tend to take Sundays off just to give us a chance to spend time with the family and do our thing. But I will see you guys again bright and early Monday morning. We are #1 on Google Podcast for Toronto real estate. Thanks to our listeners and your viewers. Leave your comments below, and I'll chat with you again in a couple days. Take care and keep it real.